Everywhere you look right now, there seems to be a bubble. Stonks, housing, crypto, SPACs, NFTs, and we all know what happens to bubbles, right? They pop. What if there was a way to not only protect yourself from the bubble bursting, but even profit from its eventual demise? Well, luckily for you, there is. They're called anti-bubbles, and in this video, I'm going to share with you what they are, why they're important, and my favorite strategies for getting exposure to them in your portfolio. I'm Max McGuire with Roundabout Investing, and my goal is to help you protect your hard-earned money by applying the principles of Austrian economics to markets that have been severely distorted by out-of-control central banks. Before we go any further, I want to give credit to investment manager and fellow Austrian investor Diego Parrilla and his book, The Antibubbles. I listened to a recent podcast with him and Jesse Felder, and a lot of the ideas in this video came from him and his book. And I'm going to put a link down to his book in the description. I highly recommend that you check it out, and also to the recent podcast he did with Jesse Felder. To understand anti-bubbles, we first have to understand what bubbles are. And for that, my favorite definition comes from George Soros. And I'm paraphrasing here, but he says that bubbles are assets that have been artificially inflated due to a false belief. And we can call that false belief a misconception. And one thing that Soros also says is this is a misconception that starts out as a reality. And I think it would be instructive to look at some past bubbles and the misconceptions that led to them. In 2000, the misconception we had was that anything with a .com after its name was going to be great, because internet. In 2008, we had the housing bubble and the great financial crisis. Some of the misconceptions during that bubble were that we could keep rates artificially low without consequences, that you could give mortgages to anyone with a pulse, and that house prices would just keep going up. In 2021, we have what many people have called the everything bubble. The difference I see between now and in the past is, in the past, a lot of these caught people off guard. This time, everyone seems to know that we have these bubbles. However, many people have been repeating the four most dangerous words in investing, which is, this time is different. Why do they say it's different this time? Well, the Fed has our back, or the Fed has learned their lessons from the past, and this time they're not going to let the bubble pop. We've got Papa Jerome, we've got the Fed put, however you want to say it. Ultimately, people think that the Fed is going to be there to save them. It sounds like we may have some misconceptions happening again. And again, Soros pointed out that these misconceptions, these false beliefs, are initially grounded in some type of reality. And this time we do have that reality. The Fed has been there supporting markets. They have been able to print their way out of the last couple of crises. But what I think is the ultimate misconception, or the misconceptions that we have now, are one, that you can solve problems by printing money. Number two, that you can solve problems by borrowing money. Printing and borrowing money do not solve problems. They actually kick the problems down the road and make them way bigger. Related to these misconceptions is the idea that the Fed has things under control, that they somehow know what they're doing and are going to be able to save the day. Despite what the MMTers say, we cannot print unlimited amount of money without consequences. But they say the bubble has become too big this time. It's too big to fail, so the Fed is not going to let it happen. In a sense, this is true. And I have no doubt in my mind that the Fed is going to pull out every stop they can to keep the bubble from bursting. They aren't even giving any pretense this time that they're going to try and normalize. However, all this is doing is transforming the bubble into more inflation and more inequality, which we have been seeing in spades. No matter how much they try, at some point the jig is up. Last time I checked, the Fed hasn't abolished the business cycle. They can prolong it, but they can only defy gravity for quite so long. They're not infallible. This is largely a confidence game. And once people lose confidence in the Fed, that is when the misconception that the Fed is actually in control becomes understood. And once the misconception becomes understood, the misconception that has been keeping the bubble inflated, well, once that becomes understood, the bubble pops. So what is an anti-bubble, and how does it protect you from the bubble bursting? An anti-bubble is the exact opposite of a traditional financial bubble. While bubbles are artificially inflated, anti-bubbles are artificially deflated. You can think of an anti-bubble as like an antivirus or an anti-missile. Bubbles and anti-bubbles are two distorted reflections of the same misconception. And just like the bubble will pop when what has been inflating it goes away, the anti-bubble will inflate when what has been compressing it goes away. And again, what goes away here is this misconception, this false belief that the Fed knows what they're doing. Okay, so what are some examples of anti-bubbles? Well, in his book, Diego identifies three major anti-bubbles. The first is gold, the second is volatility, and the third is correlation. For the purposes of this video, I'm going to focus on gold, which is the strategy that is most accessible to you and I as retail investors. However, in future videos, I'm going to talk both about volatility and correlation. So if you're interested in seeing those, please make sure you're subscribed by clicking that button below. So why do I consider, and why does Diego consider gold to be an anti-bubble? I'm going to give you three reasons. Reason number one is that gold performs best when the stock market is in trouble. We can see this from past experience and past market crashes and past bear markets. Gold is considered a safe haven. It's where people flock to when everything else is going wrong. Reason number two is that gold is a hedge against inflation. If you saw my last video on inflation, you know that it is an increase in the money supply. The money supply is something that can be manipulated at will by the Federal Reserve. Reason number three, gold is real money. It cannot be manipulated by the central banks. They cannot print gold. And really, this is the ultimate reason supporting reasons number one and two. This is why it is a safe haven when the stock market gets into trouble. This is why it's an inflation hedge. Gold has these properties of being scarce, divisible, fungible, widely considered desirable. Gold has been considered money and for thousands of years. It's proven itself over time. I'm going to be doing many more videos on gold and getting into more details of why gold is the ultimate anti-bubble, the best protection against the bursting of the everything bubble, and the best safe haven that's available to retail investors. I'm also going to put a link down in the description to my website where I have a resources page on precious metals that will give you links on investing in physical metal, gold mining stocks, etc. And again, I plan to do many more videos on the best ways, the best strategies to invest in gold. On that link to my website, I'm also going to link to a report that's called In Gold We Trust. This is an annual report put out by fellow Austrian investor and author of the Austrian School for Investors. Taking a look at your own portfolio, do you have exposure to bubbles or do you have exposure to anti-bubbles? When this thing finally goes, you're going to want to have limited or no exposure to the things that have been artificially inflated or that have benefited from the manipulation. And you are going to want to have max exposure to those things that have been artificially deflated and that have been hurt by the manipulation. Thanks again for watching, and I look forward to seeing you in future videos where I'll share more strategies about how you can protect yourself from these out of control, crazy markets.